Diligence sometimes comes across as the mystery. The letter of intent is signed, there's a closing date set, but what happens in between? Today we're going to talk about the different components of diligence. So as the letter of intent is signed and the process of finding offers and landing on the ideal offer after negotiations is settled, now there's a confirmatory period, typically 60 to 90 days, between that signing of that letter of intent by both the buyer and seller and the closing of the transaction. And so what happens during this is the buyer is typically going to provide the seller with lists of requests, and that's both information as well as materials. These are going to cover certain categories and oftentimes include several of the components that maybe they had requested earlier in the process, but that we as the advisor push back against, saying no, this is best suited if and when we decide to move forward with you. And so at this stage there's a lot of questions coming in. It's our job to shepherd that process, to facilitate and organize that, but there's certain categories that will be covered every time, slightly different depending on what kind of business it is, and that's what we want to cover. So the first, and what's always going to be the case, is the financials. And so the financials provided up to this point have been somewhat summary, detailed to a degree. However, in formal diligence, there's going to be the request for all of the exports from whether it's QuickBooks or some sort of internal system to more sophisticated ERP, Great Plains, whatever it may be, but there's going to be lots of exports being requested there. Goal is to make sure that everything presented during the evaluation period lines up with the raw data and tying things out in that regard. Sometimes companies will bring in a third party to do what's called a quality of earnings, which is effectively this process involving some other steps as well, or they'll do it internally. Depends on who the acquirer capital provider is. The next is legal. The acquirer capital provider will look through all of the contracts, want to review all of the customer agreements, and we'll leave customers to a next category. But think of anything contractual, any obligations from the company, any obligations to the company, they'll want to review those contracts and agreements. Next, with customers, there will be a deeper analysis of customer trends, customer churn, customer gains, any issues with customers, any opportunities with customers, because as they say, all business starts with a sale, and so when someone's looking to confirm a transaction, that's going to be a main part of what they focus on as well. Next is going to be personnel, and so customer, personnel, there's legal elements in all of these, but they'll want to understand the different people, where they are in their career, what their aspirations are there any agreements in place, non-competes, have there been any issues, are there any simmering issues, but understanding the people within the business as well is a big part of the diligence process. After that, you have tax. And so then the tax returns will be reviewed, again, lining up that what's coming through the financial statements is ultimately porting itself out in a congruent manner with the tax returns. The real last major component that we see is going to be some sort of a diligence depending on the type of business. If it's a software company, for instance, there'll be a technical diligence relative to coding, software, the infrastructure of effectively the business. If it's a more physical business, think distribution, manufacturing, there'll be inspections of the warehouse, there'll be inventory counts, there'll be things of that nature, again, more on a confirmatory basis. There's always this, and it's becoming more and more of all of these processes. Lastly, there'll also be an IT or some sort of technology diligence as part of every process, and whether that's as simple as looking at how the data is stored, what kind of cloud or data center is utilized for the business, all the way towards more intricate things, again, depending on the technological component or relevance to the particular business. So there are some other things as well, but generally speaking, and the sequencing of these things can be a bit different depending on who the acquirer is, what the type of business is, but these are the main categories. And so what happens is the letter of intent is signed, information requests start coming in, and there's lots of materials preparation, there's lots of materials provision. It's our job as the advisor to gather all of this information, both from the question side as well as the information side, get all of this together, have it in the data room that's organized, that everybody has access to, that's relevant to this, and both buyers and sellers, as well as their attorneys, CPAs, any third party other advisors or service providers that they bring into the diligence process, again, all subject to NDA, but these are the categories. And so someone says, what happens during diligence? It's the confirmatory review of several components of the business to feel good and to feel confirmed and evaluated and nail down the deal that was agreed upon during the evaluation and negotiation process. And to recap those, just to read them off here, again, financial, legal, customers, personnel, tax, technical, or physical, again, depending largely on the type of business. So that's the thought for today. What happens during diligence? What is the mystery? These are the things that take place between the signing and the closing of a deal, oftentimes in different orders, but it always tends to hit the same broad categories and tick the same overarching boxes. Hope the week's going well for everyone. Keep pushing forward. God bless. We'll see everyone next time.